Okay, let's get started. It's clear that we're living in one of the most amazing times in the history of money. You will ask why? Well, because money itself seems is set to transform right in front of our eyes. From the days of barter to the banknotes as we see them today and onwards to programmable money. It's also interesting that the incumbent, which is the fiat currency as we know it, seems to be venture funding the growth of its own successor. As for banks, I learned this only recently, that the first banks were in the basements of temples. And it is there where it actually started, that lending of money started, and it was also a good place to safekeep money. But banking as we know it was born when Romans took money out of the temples. And since then, while banking has continued to remain a job of banks, technology seems to be taking banking out of banks. As for venture capital, it's a new kid on the block. You know, it's only come into play about after the Second World War. But it's also very interesting to note, given that we are in a policy and capital meeting dialogue, that there was a series of regulatory innovations and policy interventions that actually helped popularize venture capital as a source of funding. There was a Small Business Investment Act in the US which boosted the VC industry because there were tax breaks that were introduced. And later on in 1979, pension funds were also allowed to invest in small businesses. If we look at innovation and entrepreneurship, these continue to be the drivers of a capitalist economy as well as of efficiency. But founders look for capital because they're looking to most likely diversify risk for themselves. Venture capitalists, of course, are interested in playing an important role in creating value for themselves as well as for investors and getting and enabling innovation to get off the ground and for innovators to actually realize their vision. It was only up to, I think, 3 years ago that capital, innovators, policy, banks, all of these were sort of living in a self-curated equilibrium. That seems to be changing right now. And policymakers, I learned this quote from Madam Siraichia. She said, you know, we as policymakers are damned if we do and damned if we don't. And I've used that before you could, I'm sorry. But they continue to worry about private capital fueled structural and systemic risks that exist in economies. And it's quite possible that as we speak sitting here, a lot of that has already creeped into many different economies. It's perhaps even an indicator for the need for policymaker monitoring tools to be upgraded or refreshed. The need, hence, for a dialogue between policymakers and investors seems to be here and now. The way we've tried to organize and lay a foundation for the proceedings of the day is to bring in about 10 quotes from different stakeholders in the money system, in the capital system, in the policy-making system, in the innovator system, and reference them to create a foundation which then we can have our keynote speakers, our panelists to slice and dice and mince and chop and come up with perspectives that can potentially be of value to all of us. Let's get started. I've spent 23 years in different banks, so I could not but start from a bank. Here's a quote from nobody smaller but Jamie Dimon. And he's talking about that the global financial system is actually diminishing in size. And he's talking about mortgage originations in the US, which were at 90% or more just 10 years ago. They're down to just 30%. He's talking about capital moving out of transparent public markets to very, very opaque private markets, and he's concerned. And he's not wrong. The UK's FCA, while they've recently given out licenses to Google, Amazon, Meta, Apple to do very, very interesting things which were up until now the domain of financial services, payments, e-money, consumer credit, insurance. but they're really worried that is this creating some sort of systemic risk? As you said, if you do, if you don't, you're damned either ways. But there is a perspective that we could put a different lens and talk about economies which need new technologies, where you have underbanked or unbanked people, vast segments of population that technology or finance has not reached. Fintechs have indeed reached where banks haven't. So if you look at an example of sub-Saharan Africa, the number of e-wallets that now exist in these markets have been propelled and fueled by fintechs and not by banks. So the number of bank accounts that got created because of financial technology companies making these inroads, and I see here Mohandas nodding because that's what we've seen in India as well. This is a very important lens to also add on to the debate. We have the treasurer of the World Bank, and I was telling him I hope I'm interpreting it correctly from a report that I pulled this out from. The report says that fintech lending is becoming significant. And if you look at alternative credit, it's expected to touch about $5 trillion in 7 to 8 years' time from now. This is significant. This is significant. And this is not banks who are actually making those sort of investments. Then if you take a different lens, a policymaker's lens, and I'm going to talk about two or three different lenses, they're talking about that fintechs just fly too close to the wind. They push the envelope, they push the regulation, and they're really not concerned about making risk lower for consumers. A good example is this was a quote that was made by John Williams of the San Francisco Fed back in 2016, and it's been requoted by the Australian Financial Services Minister. He's talking about if it looks like a duck, walks and sounds like one, then it should be regulated like a duck. And the worry is really coming from BNPL type of services that have really, if you look at the second point there are more customer calls coming up on the National Debt Helpline because it seems people are being encouraged to buy things which they don't need. So it's a perspective that has brought regulation slam dunk on many different areas, which has created, or rather destroyed value and created uncertainty for both startup investors, founders, for investors, and for people who are not just in the private markets, but even public markets. That should I be investing in companies which potentially are creating some systemic risk? Another very interesting perspective we found was somebody who could be called a father of financial technologies amongst a few of them. This is from Bill Harris, who was the founding CEO of PayPal. Very, very recently, as recent as a couple of weeks ago, he says that fintechs have complicated our lives. Now, I would have thought at least he would not have said that, but they started PayPal, created something, charged humongous amounts of exchange rates, charges against all of that. Why would he say something like that? But he thinks that fintechs are creating products which are charging exorbitant amounts of interest rates to people. An example here is payday loans. Again, he is referencing BNPL as a big systemic risk everywhere. Here are some new age fintech CEOs. Their conversation is around the regulation is not going far enough to bring data out from banks and give it to us. And that's interesting too. If you look at open banking, this is from the CEO of Trello and Blythe. He's saying open banking has not gone far enough. It's only giving access to customer account data, so I can at best offer an aggregated payment service, aggregated wealth management service, but I cannot really help the customer save money, which is hidden inside interest rates that are being charged. So I want to challenge that interest rate, which is hidden inside loyalty points that I can help them do different things with. So there is a perspective coming from the big fintech CEOs that policy is not going far enough. If you take another view from the World Bank, they're talking about because so many different entities are now bringing financial services to the same person, who owns the customer itself is in flux. It's not clear anymore. Is it a bank? Is it Google? Is it a small fintech? Is it a credit company? Is it a mortgage company? Is it a BNPL company? Is it Amazon? Who owns the customer? So there is potentially a need for an aggregated body, maybe across all jurisdictions, which brings data at a central level, customer as one, and then somehow creates a structure around it which can potentially solve this sort of a problem. The newest kid on the block over the last 3-4 years is national security interest. We've seen this happen in a very big way. In fact, it was quoted to be the most significant policy debates that's happening right now around the world, that how do you allow for venture capital and capital markets to be free, open, at the same time not create risk and be able to protect national security. So the US FIRMA Act that came in has impacted the US VC ecosystem. There are investors and startup founders who are worried that should I go down this path, is it something that I should not, because 3-5 years down the line when I've really created value, when my product's really working, when I have customers, can something come and slam dunk it and destroy it? So there's hesitation that has come in all these areas. Once the US did it, Canada, Germany, and EU followed, and China then retaliated. And we have Jonathan here. It'd be very interesting to hear your perspective, Jonathan, on China. And the Chinese investments in 2019 have fell to their lowest since 2015. There's a very interesting perspective from, and I don't know if there's somebody from FT Partners here, which is, of course, a fintech investment banking arm. They track data, and they're talking about the deal activity volume has come crashing down in the last 3 quarters. And we all know this, the funding winter, as it's called. The deal volumes are down, the deal values are down, the average ticket sizes are down. It is a problem. What does this really mean? It means that innovation is getting curtailed. It means value creation is getting curtailed. It means efficiency is getting curtailed. Is this a problem that needs to be solved between policymakers and investors? Lastly, let's take a look at from the Bank of Central Banks, which is the Bank of International Settlements. It's interesting that they say there is no need yet for structural refresh. Now, with that sort of a background, I personally argue that maybe there is a need for it, and they do a bit of things, but this is a perspective from January of a couple of years ago that fintech has not changed the core mission of financial regulators. In their core content, these are 3 very important lines written there. The rule books on prudential safeguards, consumer protection, market integrity remain unaffected. With that in background, let's get started.